Welcome to Bloomberg ETF IQ Europe. I'm Francine Lacqua, and over the next 30 minutes will be your guide to the region's thriving market in exchange-traded funds. Everything you need to know about the funds and the flows. European ETFs took about 62 billion euros in the first 9 months of 2020, almost matching the same period last year. With political uncertainty in focus, can the market still top 2019's record outflows? ESG fund flows have been in the green every month this year, even during the coronavirus sell-off. We'll discuss whether the sector is here to stay or just another stock market bubble. Plus, how smart is smart beta? A new study says the funds do deliver outperformance, but they're not quite as smart as you might think. We'll bring you that story as well. So let's kick it off with a look at which countries and sectors have been attracting the money. Here's our Danny Berger with analysis of the numbers. Hi, Danny.
Hi, Francine. That's right. I've got FFLO Go up for us. So again, this is a look at different ETFs that track different countries. And through the past month, we've seen net inflows into European ETFs, a total of $526 million. But that headline number, that net number, does obscure some of the volatility underneath the surface. Now, at the top, we have countries like Switzerland and the UK getting $190 million worth of inflows over the past month. Majority of that, and really recent flows, have been to gilt ETFs as a slew of issuance set to hit the markets continues to depress yields, sending those bond prices higher. Interesting, though, I look at the divergence between Italy and Spain, and I want to point that out, the inflows to Italy and the outflows from Spain, because a lot of that is centered around government bonds. Italian bonds used to be the pariah of the market, but they've been getting inflows, whereas Spanish bonds have been underperforming their regional peers. Now, a lot of this is because Spain is really the hot spot of the coronavirus epidemic here in Europe, with second wave fears coming to fore. Now, also want to point out that Germany having outflows for the week. Germany is a really interesting sector and geography to watch over the coming months, because the owner of the DAX has proposed new changes that would alter the index. And of course, billions of euros here in Europe track the DAX via ETF. So what would this mean? They want to increase the number of members. They also want to have a new audit committee and faster exit for companies that aren't up to standards. Now, you could imagine that a lot of this would be in response to Wirecard. It really took 2 months for Wirecard to be taken out of the index after it collapsed following allegations of fraud. And we've seen the ETF community react. At the end of last month, Vanguard switched its Germany ETF out of a DAX tracker and into a FTSE German ETF tracking index, because they said they wanted more diversity. They wanted more companies they track. Now, these decisions, these proposals will be decided next month in November. So we have a little bit of time to find out whether those changes do indeed take place. But again, big consequences here for the ETF world, Francine.
Thank you so much, our Danny Berger there with the very latest of what we're seeing in terms of funds and flows. Joining us now is Andrew Jameson. He's Global Head of ETF Product at Citigroup. Andrew, great to have you on the program. Danny was bringing us this important story about the DAX. Does the fact that the DAX index, become broader actually change the world of ETFs exposed to the DAX? Does it make them more attractive?
Look, I think anything that broadens investor exposure is definitely to be welcomed. Ultimately, at the end of the day, what you're talking about with a DAX ETF is a passive investment vehicle. So it will ultimately track what the market's doing, and therefore they should be largely neutral in terms of index reweighting. But certainly, ETFs will fit the bill.
Were the ETF providers actually hesitant to track the DAX after the Wirecard fiasco?
No, I wouldn't say so. I think, again, if you think about the fact that these are passive investment vehicles, they're merely replicating the broader market sentiment or the broader market implications. So clearly, in a reweighting or rebalancing, something being ejected from the index, that would happen in an orderly fashion within the ETF. And should be considered as part and parcel of any other kind of reweighting that occurs on a regular basis.
But do you think, Andrew, maybe some of the ETF providers were putting pressure on for the DAX to include this, or what kind of lobbying goes behind the scenes?
No, I wouldn't say so. I think, again, the ETF is there to replicate the index. I think what the index providers would try and do is ensure that they could do so in an orderly fashion. I think they would certainly be keen to get some clarity from the index providers that are determining whether Wirecard should or shouldn't be in an index, so that they can adapt and react very timely and in an efficient manner, so that the investor is protected. Because ultimately, uncertainty is the biggest challenge. So the more clarity, the more communication, the more understanding there is in the process, then clearly that's best for the investor and it's best for the issuer.
Andrew, speaking of volatility or uncertainty, we're going to the US election. There's a lot going on with Brexit negotiations. How will that play out in the world of ETFs?
Yeah, I mean, look, we're in uncharted waters or territories, they say. I mean, look, I think it's well documented fact that ETFs are often used as a barometer of investor sentiment. They offer a broad range of precision exposures, and flexibility in use case means that often they are that vehicle of choice to deploy in fast-moving markets. I mean, you've mentioned the COVID pandemic, the imminent US elections, Brexit, Trump's medical condition. All of these are sort of a heady mix in terms of uncertainty. But what I think has been really refreshing is through this COVID period, what we've witnessed is how ETFs have been fit for purpose. And they've often been quite maligned in terms of criticism in the past, suggesting that they wouldn't perform under market uncertainty. But I think that has largely evaporated, that uncertainty. I think they've come through with flying colors. And the fact there are so many broad exposures that you can use through ETFs across all the various asset classes, I think undoubtedly there's an ETF for you, irrespective of whether you're feeling bullish or bearish.
All right, Andrew, we'll talk about some of the ETFs for you. Andrew Jameson there from Citigroup stays with us. Now, coming up, money has been rolling into smart beta ETFs in Europe this year. A new paper says the funds do deliver outperformance, but they're not quite as smart as you think. That story is up next. This is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. So just how smart is smart beta? Well, quant strategies, which try to sit somewhere between active and passive investing, have swelled to a fifth of America's ETF market and have been taking share here in Europe as well. A new academic paper has confirmed that the approach does deliver outperformance, but not for the reasons you might expect. Well, let's get more with Gregor Stewart-Hunter, our cross-asset reporter in Hong Kong. Gregor, hi. What did the researchers actually say explained the outperformance of smart beta?
Okay, so the promise of smart beta has always been that you have a predictable rules-based strategy that you can package up and put into an ETF and get all the outperformance of a quantitative strategy within a low-cost wrapper. And what the research has found is that while it's possible to do that, it's actually not because of the factor tilts. These are the style factors that group stocks by things like growth, value, momentum. It turns out, the researchers found, the amount of time and energy and research dollars that quants are spending trying to figure out which ones work best aren't actually delivering the returns. Instead, it's the diversification that's embedded in all smart beta strategies and the way that these approaches reshuffle the stocks more regularly than a simple market cap weighted index that's actually giving them the greatest return.
Gregor, what are some of the counter arguments that the industry has put forward on this?
Yeah, so it's been an argument that's generated a little bit of controversy so far. One of the most intuitive reasons to find fault with the study is that if you think about how most quantitative investors would approach creating a portfolio, they would generally come up with a long version and a short version in their testing process. And if those both employ the same rebalancing strategy and one works and one doesn't for the reasons that you think, then it can't entirely be because of the rebalancing that they're getting the the gains that they're expecting. It must be something to do with the factors involved. And the other issue that the researchers acknowledge is that they're using back-tested portfolio data. We've written also elsewhere about that and how a lot of the time when you use these back-tested studies, you find that what works in a laboratory setting doesn't always work in a real-world environment once a strategy is repackaged as a fund.
Looking forward, does this give the quants something useful for their research efforts?
Quite possibly. The researchers suggest that it's maybe worth their while thinking more about rebalancing strategies and how those can be approached. We've seen other studies looking at how the timing of index rebalancing can actually add quite a lot of performance to smart beta funds. So it could well be that these quantitative strategies are leaving money on the table here, which with more research they may well be able to pick up. It's just not from spending all their time and energy sussing out whether growth or value is going to do best.
Gregor, thank you so much. Gregor Stewart there, Hunter, our cross-asset reporter joining us from Hong Kong. Now still with us is Andrew Jameson from Citigroup. Andrew, how do you look at smart beta?
Well, look, I think you have to really compare like for like. So smart beta or enhanced beta is not the same thing as traditional vanilla index investing. I think that's sometimes the challenge. People are saying, is smart beta better than the traditional passive products? But you have to realize that the outcomes are not going to be the same. If you think of smart beta really as that sort of second generation of passive investing, it's trying to filter out certain attributes. And as a consequence, it's really risk-driven. And I think that's kind of what we just heard from Gregor, is that, factors often come into play, whether it be volatility, momentum, growth, etc. But, I think really you should think of smart beta as some way a sort of a halfway house between traditional passive and traditional active investing. And it's seen as a cost-effective and less risky alternative to traditional pure play alpha. I think what's really interesting is the fact that we're already starting to see in the US the rise of semi-transparent or even non-transparent active products using the ETF wrapper. And I think that's something that is likely to come to Europe in due course and ought to be viewed as a more natural competitor to traditional active mutual funds rather than smart beta. So I think that really just goes back to the kind of the original argument that ETFs are merely a wrapper or a technology and not an asset class in itself.
Andrew, how quickly will it come to Europe? So you say in due course. Are we 6 months away? Can it take 2 years? And how big will be the size?
It's hard to say, Francine. I mean, I think it really depends on how the US experiment goes. I mean, this is still relatively a new phenomena. We saw the first approvals at the tail end of last year in the autumn. Obviously, COVID has had a big effect in terms of potentially putting things on hold and people taking a step back and perhaps not working as they had previously. But I certainly, if I was to try and have a guesstimate, I would say something in the next 12 to 18 months, we might see the Central Bank of Ireland or the Luxembourg authorities say, let's give this a pilot program in Europe and see how it goes.
All right, Andrew, thanks so much. Andrew Jameson there from Citigroup stays with us. Now, coming up, green ETFs have seen inflows of over $18 billion so far this year. That's more than double the amount seen in the whole of 2019. But is it just another stock market bubble? We'll discuss that next. This is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now, in a record year of ETF closures, one area is defying the trend. So far this year, 16 funds focused on environmental, social, and governance themes have made their debuts. That's well ahead of the 10 that were launched in the whole of 2019. So are we seeing the start of a much bigger trend, or, as Jared Dillian from Molden Economics argues, just another old-fashioned stock market bubble? In his Bloomberg opinion piece, he goes on to say that ESG has become something of a self-fulfilling prophecy driven entirely by liquidity and flows. Well, still with us is Andrew Jameson from Citigroup. Andrew, what's your take on ESG? How much more can the ESG ETF space in Europe grow?
I think a lot. I mean, look, without question, ESG has been the hot topic of the last 12, even 24 months. And certainly Europe has been at the center of that adoption. It's hard to have a meeting with an asset manager, let alone an ETF issuer, without ESG really being at the epicenter of their thinking. I think, however, we're still very much in the nascent phase, and products are still relatively unsophisticated and mostly exclusionary in nature, rather than driven around governance or, more importantly, impact investing. That will develop over time, but I think we're in that kind of early arms race to rebrand indices and to try and own the space. But largely, a lot of these products are effectively copycats of existing products, but excluding certain stocks. But I think the COVID pandemic, if anything, has really sharpened people's minds and perhaps even changed people's priorities. So I think, ESG is definitely something that is very much in focus. And even in the US, where it was largely seen very much as a fad pre-pandemic, I think it is certainly coming to the fore. But, I think that there's more needs to be done. And I think particularly really within the asset management community itself. And I think they have to look inward on their processes and the role they play. I remember Danny was mentioning a week or so ago that in conversations she had with leading managers, they said they simply didn't have the bandwidth to handle things like voting because they own, many thousands of stocks. And, I think really that sort of process will need to sharpen up. I don't think that will be acceptable in the future. People will either have to get the bandwidth, or better still, they'll have to invest in technology to automate the process. And, there are products out there today like Proximity that do digitalize the voting process and allow that sense of governance to be a lot more transparent.
Yeah, let me just go back to ESG for a second. Is there a part of the ESG world that will be much more attractive for ETF players? Is it, is it social change? Is it diversity, or is it still climate change?
Well, I think that's the challenge, Francine. It's really, we're still in that early phase, and the issuer community is trying to figure out what they can actually do within their existing infrastructure. What does the end investor seek today, and how that will evolve over time. But I think if we get into this ESG revolution at a higher pace, and as it reaches a greater level of maturity, I think that's my point, where the money managers themselves will have to be much more around the governance that they display, as opposed to just saying, I'm picking a stock because I feel it's green. And I think that will be driven by investor sentiment.
Thank you so much, Andrew Jameson. We'll get back to Andrew shortly. Now let's take a look at this week's winners and losers. Here's Danny Berger with your ETF leaderboard. Hi, Danny.
Hi, Francine. Unfortunately, no ESG ETFs at the top of the leaderboard today, but there are definitely some interesting moves. The biggest flow getter over the past 5 days was a BNP France-listed S&P 500 ETF, about $300 million or so going into that. The question is, what is behind these flows? It is a more expensive ETF than a lot of the S&P 500 ones out there. BNP itself is the largest shareholder of this ETF, so it wouldn't be unreasonable to conclude that BNP itself is behind these flows. Coming in at number 2 is a PIMCO short maturity, getting about $250 million worth of inflows, again, tracking that short duration part of a European corporate debt. And look, this is something that PIMCO itself says that it targets a lot of yield. It's a less volatile place. So almost more of a cash replacement. So some risk-off tones there in that second biggest flow getter over the past week. And then finally, another S&P 500 ETF, one from iShares. This one's listed in London, getting $210 million worth of inflows. Looking at the other side, though, we have corporate bonds yet again hitting the top of that outflow board. This iShares one seeing $300 million pulled from it over the past 5 days. ECB maybe pulling back on its funding a bit, but there's some question as to whether they'll step back in with the recent developments in rising coronavirus cases. And S&P 500, these funds all over the place this week. We also see outflows from an Invesco one. And finally, that MSCI World Swap Index. It's an interesting one. We talked about this last week, Francine. It's a synthetic ETF, which means it uses derivatives to derive its exposure to the MSCI World Index. These types of ETFs have fallen out of favor after the financial crisis, but they've come back. The idea being that if you're using swaps, presumably you'll have less tracking error. It'll more similarly reflect the performance of the index because you have someone guaranteeing that exposure. So yet again, we see another instance where these synthetic ETFs are picking up in popularity, Francine.
Danny, thanks so much. Danny Berger there with the very latest on the leaderboard. Let's get final thoughts from Andrew Jameson from Citigroup. Andrew, how do you trade through ETFs the U.S. elections?
Gosh, I mean, that's a difficult challenge. I don't think anyone really knows at this stage, really what the outcome's going to be. And we're seeing a lot of volatility on a day-by-day basis. So, it's difficult to say what that outcome is likely. But certainly there will be ETFs that will allow you to play, whether it's a flight to safe haven, such as gold, whether it's a surge in the stock market on the equity plays, or whether it's a move into the treasury market or high yield. We've seen some fluctuations in high yield, and maybe we'll see some inflows again.
What's the part of the market that you find, most interesting, Andrew, maybe because it's most unloved in the ETF space?
Well, look, I think I'm just generally very excited about the whole market-wide opportunity at the moment in Europe. And, certainly, we're doing a lot at Citi, and we're very excited about the opportunities there. I mean, I think you're going to see continued growth. And in my personal opinion, I think ETFs are going to evolve into that long-term natural successor to the traditional mutual fund. So I think as an adoption of the product, that's super exciting. I think, as we touched on earlier, semi-transparent, if that comes to Europe, that will be a big move. That will potentially bring in lots of new players that we haven't seen in the past. That sort of reluctance to get involved because it was seen as a passive-only wrapper, but that will definitely dissolve. And I think some of the legacy hurdles on the retail front around technology and products will disappear. So we'll move forward. So there's a lot of exciting opportunities, and we're building out, we're developing, and we're getting new mandates.
Andrew Jameson there, Global Head of ETF Product at Citigroup. This is Bloomberg.